Hi, everybody. Thank you for joining today's, actually the July CMBS 3030. It's hard to believe that we're more than halfway through 2021. Someone said that to me today, and I thought, oh my gosh. And that kind of sets the stage for what we're going to talk about today in this session. And this will be 30 minutes, so we'll end promptly at 2:30 Central, so you can all set your clocks accordingly. And here's a couple things we're going to go through, but we all know that COVID caused revenue, lost revenue on hotels forever. That revenue's not coming back. That year or however many months you had of lost revenue. We know that all the relief that was granted for COVID was in the form of deferrals only. So it all had to be paid back and has to be paid back. In most cases, that payback is starting now. So the way the relief was granted was basically that kind of the standard longer term relief we saw was 12 months of deferral, and the payback started when the deferral ended typically, or best case, worst, longest we've seen is you started paying back in January of 2022. So most people, if you have a hotel or other property type, so I'm going to use hotel in my presentation, if you will, today, because it's a stark reality and it's easier to understand, I think, the major revenue hole that we're dealing with. But all property types have probably experienced, not all, but the other property types have experienced similar things. But the long-term good relief we got was 12 months, and it all had to be paid back starting now. So that's what we all know. I think you've all heard me say that. You all know that. What you may not know is that there's still a lot of loans in special servicing. Some of you on the call today, I know, are in this position because I can see who you are. But many loans today that are still in special servicing and waiting on the final approval and documentation of their COVID relief, believe it or not. Now, when the docs are signed, likely the relief is up and you already have to start paying. But I'm going to give you statistics here, but a lot of loans are still in special servicing, waiting for COVID relief. Let me give you just some fun facts before I get into the options and the resolutions that are out there for you. So some facts here. Pre-COVID, so March of 2020, there was about 12 billion in special servicing, and those were mostly retail. CMBS, just so you guys all know, is about 20% of the overall commercial real estate debt market, which is, I don't know, I've heard 4 trillion or something. So, but anyway, we had 12 billion in special servicing pre-COVID. By June of 2020, we were over 50 billion in special, and most of those then were hotels. The high point, the high watermark of all loans in special servicing was September, and that's 56 billion. Okay, now I'm going to start going down. Okay, so now let's go the other direction toward the over the hill, if you will. So April 2021, I would love it. I'd love it if we were in an open forum and I could ask you this question. But if we had 56 billion in special servicing at the high point in September, I would love to know what you think the April 2021 number was, because you would think, oh, mostly it was behind us. Believe it or not, there were 48 billion in special servicing still in April 2021. And now at this point, we are down to about 26 billion. Okay, now so when you see graphs and you see where things are relative to COVID relief and deferrals, COVID relief and loans and special servicing, you generally see just a little bit of that graph, and it makes it look like it's all been resolved and all through for the most part. But if you stop and think about it, even 26 billion is double what it was pre-COVID, right? And the reason there's still 26 billion in special servicing is a couple of reasons. One is some of these deals just haven't entered into their forbearance yet. As I talked before, there's a large amount of those. Some have entered into a forbearance agreement and are being monitored by the special servicer still. And the majority of all these loans are still hotels and retail. No surprise, but those are the big property types that are driving all of these numbers. Now, when you see the decline in special servicing each month, and you start hearing that, you know, the workouts or the special servicing default rates have gone down, things are good. It kind of seemed like, if you hear that, you know, COVID's behind us, problems over, we can all move forward. And in fact, I've gone to some conferences. Actually, my first in-person conference in Atlanta a number of months ago, but you know, if you sit there and listen, it sure sounds like it's all behind us. COVID relief has been granted, default rates are going down, COVID's behind us, the problem is over. But I'm normally an optimistic person, but I will tell you the problem, as you all probably know, is far from over. When you lose a year of revenue, and you're not going to get it back, but you still have to pay back all your debt, there's a big hole that has to be filled. So what I'm going to talk about today, leading up to all of this was all leading up to that. What I'm going to talk about today are the things we're seeing hotel owners, other owners do to fill that hole that was created by COVID that you're never going to get back, right? Okay, I'm going to tell you the 4 options I think that are available, and then I'm going to go through each one in a little more detail. Not necessarily in order of what we're seeing, but maybe kind of turning out that way. One option is to add preferred equity to your structure. So there are a number of, you know, distressed capital providers out there in the market, and they're having to be a little creative as to how they deploy their capital. So they're coming up with the ability to invest in existing ownership structures. So it's a good resolution. I'm going to talk again a little bit more about it. But so adding preferred equity, you stay in as owner, but you add equity from outside. Another thing we're seeing, the second, is now resort to a permanent modification of your loan. And I'm going to talk about when that applies, and by default, sorry for the pun, there's a lot of times it won't apply. So don't immediately hear that and say, oh, that's what I'm going to do. I'm going to talk through how that works. Third one, and I think this might be one of the more popular ones that we're seeing, and I know a few of you on this call have had to resort to that, and that is sell your property. So you have this revenue hole, it's not going to come back. You know, instead of bringing in outside equity, maybe you just opted to sell your property at this time. And we are seeing a lot of uptick in the amount of sales that are going on. And the last one, and you all know it's there, but I want to just briefly mention it. But that's a deed in lieu, right? And that's, if the property that you have was performing pre-COVID, likely that's not a good option at all for you. But it's definitely still one that I wanted to cover. So I think those are the options other than self-funding. So you got your COVID relief. You're a year and a half, year or so down the road. You're paying now full payments likely, and you're also having to start very soon, if not now, to pay back the deferred amount. For some hotel owners, that has equaled 2 full payments because they deferred 12 months, had to pay it all back in 12 months, and are having to pay a regular full payment. So these are all painful resolutions. So it's a matter of which one is the least painful option. All right, so I'm going to now talk a little bit more about each one. So let's first talk about the preferred equity. I think it's a great resolution, provided you find a good cooperative capital source, of course, and ideally one that has provided preferred equity on a CMBS deal before. If they haven't provided on a CMBS deal before, it's going to be a bigger challenge because they have a big learning curve. The challenges that come with this, all right, is that to put pref equity in a deal, typically, I've never seen it otherwise, that capital structure will want some kind of control rights. In the event of a default, in the event that you do things, they'll want to be able to have some control. They may even want the right to, some horrible instances they want to step in and take over as owner. So due to the springing control rights or the control rights they want now, and the fact that they could potentially step in and be the borrower in some, excuse me, couldn't stop that, in some cases, it will require servicer approval. Now, this can't be mezz debt packaged as preferred equity. And one of the couple things that you immediately do as a sniff test to determine if it's really mezz debt is if it has a fixed payment. So no matter what your NOI is, your net cash flow, you still have to pay X on the preferred equity. That's not preferred equity. And it also can't have a maturity date. It may have a pay me off by date, but it can't mature. It can't look like debt. There are other ways. There are other criteria that will exclude it from being preferred equity. But bottom line is, if it's true equity and they will invest with you, the approval, the servicers will have to approve it. Sometimes there will be let me back up. There will always be a fee. We're seeing sometimes the fee as high as 1% for the amount of preferred equity that you're putting in. We've had a few servicers, believe it or not, who came right out, and I've had 2 of the 5 big special servicers initially, when we submitted these requests, came back and said, oh, by the way, we don't approve preferred equity. And, after spending a little time with them, we talked about, so let's look at the options here. You've got an outside source that's bringing in equity, which will help fill this hole created by COVID. If you don't approve that, then these deals will not perform. They will not perform. They will not have a solution, and you could potentially be getting a defaulted loan. So you have to really explain this. Don't take the first, oh no, we don't do preferred equity as an answer. We really have to push these servicers to consider this as a resolution for these, for hotels that have this big gap to fill, this hole. Always remember, when you're going into the servicer for approval, all servicer decisions are based on, what's in it for them. And this does have a lot in it for them. It is tremendously valuable to them. So these should be approved. Now, if you're going to recapitalize your firm in any way, so maybe it's not pref equity, but you're going to recapitalize it anyway, bring in any kind of partner, remember that it does take servicer approval. Whenever that new party has any control at all, ever, or the ability to step in and be the borrower upon your default at any point ever, it definitely requires servicer approval. And of course, we help with that. So that's the unwritten part of this. But so preferred equity may be a good solution. Lots of providers out there. We are getting hounded with people who say, hey, let me know if you know of any borrower who needs this, because we have a lot of it. So if you're in that situation, we can certainly connect you to many, many good preferred equity sources that know CMBS. So that's a good option. That does allow you to keep the property. It does fill the hole created by COVID, and at least, we'll all live to see another day. Okay, I'm going to do them in a different order, but let's now talk about selling your property as an option. Plus, and I'm not an expert on this, I've done a little bit of research, but we're seeing a lot of sale transactions happening right now. A bit of it is because of this hole created by COVID, and there's no other solution. The other is because of this looming potential 1031 exchange law changing, and that's the part I'm not an expert on, but I'm hearing enough about it, reading enough about it, understand what it is, that if that happened, I think it's creating a lot of sale activity anyway. I get asked this question at least 5 times every single day, based on all of the hole created by COVID. Hey, will the servicer just waive defeasance? If they would, I could pay off the loan, go on with life, it would all be good. And I will tell you, the answer to that question is always no. Of course, you can never say always in this industry, unless your property value is less than your debt amount, the answer will be no. So servicers are not waiving defeasance just because of COVID, okay? So you're selling your property, they're not going to waive defeasance. That means your buyer has to assume the loan, all right? Now, assumptions are different now post-COVID, if I use that word, post-COVID. Think of, I was thinking back, preparing for this, and I thought, okay, think about some recent big events and how they changed underwriting requirements. 9/11, I was in servicing at that point, and I remember from that, after 9/11, all the focus was on ensuring every property had terrorism insurance, because we couldn't miss that again. The downturn of '08, underwriting tightened tremendously. Same kind of thing has happened as a result of COVID for assumptions. All right, so the debt's in place. They can't require a pay down. In fact, they don't allow a pay down. So they get their pound of flesh, or they get their conditions in other ways. So you really want to know what those conditions are and where you can push back and where you can't. Sometimes it's a non-starter, but other places you can push back. And also know that the loan to purchase price can affect your conditions. So your property is selling today, and the LTV on the current debt is, pick a number, 85%. At origination, it was 70%. There's a huge gap there that, although you can't pay the loan down, you know that the servicer will look to bridge that gap on their end some way. So there's different ways they do that. And, we can go, these are loan by loan by loan. You can't give you can't give, overreaching standard answers here. So these are things where we need to talk to you about your deal, your servicer, the conditions we've seen. But all predictions are that there's going to be a lot more hotel trays over the next year. And for those that were performing previously and hit by COVID, beware, be alert, be cognizant, just be knowledgeable about the fact that there are going to be conditions placed on the assumption. Still a good resolution. Okay, then let's talk about the payment or the permanent modifications. So I know you're all hearing me probably thinking, oh, you're probably making a note to consider that as your next option. So I'm going to give you some clear questions and things to consider to determine your loan's eligibility for a permanent modification. Okay, so number one, will the property recover value-wise and debt service-wise by the maturity date? So if your maturity date's a couple years out, you got hit by COVID, you were performing pre-COVID, stop and ask, will you recover potentially value-wise and debt service-wise by maturity? If your answer is not a clear no way, and I'm saying that on purpose as a double negative, because the answer to that question in all cases is, well, it depends, and depends on this tenant, what happens in retail, what the market does. So I get all that. And so if it's any of those kind of things, well, depends, maybe it might, then you are not a candidate for a permanent modification. If the answer to the question is a very clear no way, no way will it recover by maturity, then you are potentially a candidate for permanent modification. Now I have to ask this as a next step. So let's say you say that, okay, so it's clear that it will not recover by maturity. I think I need to permanently modify my loan. Now ask this as a next question. Is it possible that if you get a 2-year extension on your maturity date, that in 2 years later, your maturity date now is extended 2 years, would you possibly recover value-wise and debt service-wise in those 2 years? If you say, well, could, then you maybe need a maturity date extension. If the answer is still no, there's no way it's recovering by maturity and there's no way it recovers in 2 years, you're definitely a candidate for discussing a permanent modification. What I mean by permanent modification versus COVID deferral is night and day. COVID deferral was kicking the can down the road. Nothing was forgiven. Nothing got fixed. You still have to make all the payments. You just got some time to do it. Okay, fine. That helped in a lot of cases for COVID, thank God. But, so that's COVID relief. Permanent modification means the gap between what you get today and what you had previously never has to be paid back. It's your terms are modified. So maybe you permanently modify your loan to an interest only at a low number. Maybe a discounted payoff is warranted. And you may have heard me say before, DPOs are not being considered. They're only considered where, again, there's no chance that the value of your property gets back to its where it needs to be by maturity. Okay. So discounted payoffs, if that is the answer, it will not recover, then a discounted payoff may be viable. And we're starting to see some kind of hybrids, couple hybrids of these things. Well, one is you essentially do a short sale in essence. Now, it's not called that, but the value of your property is below the debt today. It will not come back by maturity, but you do not want to take advantage and get a discounted payoff and come up with all that money. You might sell your property and the buyer can come up with the money and close on a discounted payoff. We'd have to explain that. So the buyer there is essentially the discounted payoff funding. They wind up getting a clear, property with no liens on it. You pay the loan off, life goes on. So those happen. We're also seeing, so let's say that your feedback here on these questions is there's no way my property is recovering by maturity. And the servicer doesn't buy that. What we're seeing sometimes now is a kind of a new concept where you do a permanent modification to the payment today, and you determine the value at maturity, and you can pay it off at a discount based on its value at maturity. So it's basically a future DPO that you decide the amount on at maturity by current value to appraisals and so on. So we get into that. But so what we provide to you for Service Solutions on these modifications is the menu of options. I always say, so this happen all the time. You hear that your neighbor got the most wonderful discounted payoff solution in the world. Let's say it's for a minute, let's use it as a restaurant analogy, and they got the world's best, hamburger you can ever get in the world. And you say, boy, that's what I'm going to go get today. So you drive to, and for those of you who have not heard this, I hope you know what a Chick-fil-A is. They're all over here in Texas, and I think lots of other places. But Chick-fil-A, you could drive up to Chick-fil-A, and if they didn't have a menu, you could drive up there and ask for a hamburger or cheeseburger, and you could be there for a long time and still not get a cheeseburger because they don't sell that. And I'm using that analogy that's kind of corny, but only to describe that certain servicers have, well, all servicers have a menu of options they'll consider by pool, by controlling class representative, and those menus change all the time. Like this new future discounted payoff concept, we just got approval on recently. We were able to introduce that to another client and use that on another deal. So that's what we offer you here more than anything on permanent modifications. Okay, in the last few minutes of this call, let's discuss now. So all that fails, you decide, you know what, I'm just fatigued, I'm done with this property, I've been funding it for a long time, I'm done, I want to hand it back. Okay, so that's the beauty of non-recourse lending, is you can hand the property back. And that sounds simple in essence, and it can be, but you have to be sure that you don't trigger any of the recourse carve-outs along the way. And that gets exceptionally tricky when the servicer is holding all your cash. So along the way, the servicer will likely, you'll be in cash management, or they'll have control over your cash. And it's going to be really hard to remain non-recourse when they've got all the revenue coming in. So I would just recommend that you get really good advice along the way if you decide to go down this option. So in summary, if you got COVID relief, first of all, if you didn't get your COVID relief yet, and we keep telling you we're close, please believe me and know that there are plenty still in final stage of approval and closing. If you got your COVID relief, it's probably up, and you probably very soon, if not already, have to pay back all the deferred amount. It's painful. A lot of these properties never supported 2 payments pre-COVID. So this is going to be painful. I know it is. Servicers are not giving any more relief. So you got to figure out how you're going to fund that hole coming up. Again, preferred equity, good solution. Permanently modify your loan, good sometimes. Selling your property might be the only resolution that makes sense to you. That's possible. Know that the buyer will likely have to assume the loan and be prepared for those conditions. And then you got a deed in lieu. So those are your options. As always, I hope you know that I'm always, I talk about everything at a high level. Everything at the end of the day comes down to your deal, your special, your CCR, controlling class representative. And so always do free consultation. Always happy to talk about your deal at any time. So please don't hesitate to reach out if you'd ever like to do that. The next CMBS 3030, can't even imagine, but it'll be in August. I'm going to look on my calendar so I can give you the date. I think it's August 10th. Maybe it's August 3rd. I'm sorry. It's August 3rd. So Tuesday, August 3rd at 2 p.m. Central is our next CMBS 3030. What I'm hoping we'll have at that point is more update on these alternative methods of bridging that hole. I'll also share with you the amount of loans in special servicing. I do anticipate that will go back up here pretty soon as we get to these payback requirements in terms of COVID. So I hope you all have a great day, great rest of July, and guess we'll talk again in August. Thank you.